Hey everyone, welcome back. If you are renewing your mortgage today or buying a new home, you're facing one of the hardest questions in Canadian real estate. Should you choose a fixed or a variable rate? In today's high-rate environment, this choice is less about which rate is lower right now and more about managing your risk tolerance and predicting the market. For the average Canadian homeowner, the wrong choice can mean paying thousands more in unnecessary interest or huge penalties. Today, I'm going to break down exactly how each rate works, show you the biggest hidden risks of both, and give you a simple framework to help you decide which is right for you right now. Let's start with the fixed rate. This is the security blanket. How it works: the interest rate is locked in for the entire term of your mortgage, usually 5 years. Your monthly payment remains exactly the same for that whole term. What it's based on: fixed rates are primarily based on the bond market and the long-term outlook for inflation and interest rates. The biggest benefit: stability. You know exactly what your monthly payment is, making budgeting simple and stress-free. If the Bank of Canada hikes its rate tomorrow, your payment is untouched. The biggest risk: fixed-rate mortgages come with the highest penalty for breaking the contract early. This penalty is usually calculated using the interest rate differential, which can be massive if you sell or refinance before your term is up. If you think you might move, renovate, or need to refinance, be extremely careful with a fixed rate. Next, the variable rate. This is the calculated risk. How it works: the rate is tied directly to the lender's prime rate, which is directly influenced by the Bank of Canada's overnight rate. The two types: fixed payment, variable. Your monthly payment stays the same, but the portion going to interest versus principal changes. If rates rise too high, you hit your trigger rate, and your payment may need to jump drastically.
Adjustable variable. Your monthly payment changes every time the prime rate moves. While less stable for budgeting, you always pay down principal effectively.
The biggest benefit: if rates drop, your monthly payment or the amount of interest you pay drops immediately. Historically, over the very long term, variable rates tend to save borrowers more money. The biggest risk: uncertainty. You have to be able to absorb payment shock if rates spike unexpectedly. You need a strong emergency fund and a high-risk tolerance. Given that we are likely near the peak of the interest rate cycle, how do you decide? Use this simple decision matrix. If your goal is budgeting security, you should choose fixed. This avoids any sudden payment shock, buying you peace of mind. If flexibility is your goal, especially if you're likely to move, sell, or refinance in 3 to 5 years, choose variable. The penalty to break a variable mortgage is usually only 3 months' interest, much cheaper than a fixed-rate IRD penalty. For the highest potential savings, if you're willing to ride out the market, choose variable. Rates are predicted to drop sooner than later, which benefits variable holders immediately. For maximum repayment speed, choose fixed. If you can lock in a low rate and use extra payments, you maximize the principal paydown. My advice: if you cannot afford a 1% payment increase without stress, choose fixed. If you are financially robust and believe in the eventual rate drop, variable offers the best long-term play right now. Choosing between fixed and variable is a deeply personal decision that should reflect your financial circumstances and your future plans. Before you sign anything, let a professional mortgage agent analyze your entire financial profile. We can run the scenarios, compare the penalty costs, and look at exclusive rates that banks won't show you. Click the link below and book a free consultation to find your optimal rate strategy today. Thanks for watching, and I'll see you next time.